Kim joins me here today, and you could learn what his team is up to by heading over to sharesfr.com. That's sharesfr.com. That's going to be a clickable link in the show notes. But really appreciate your time here, Andrew, as we talk about single family homes as rentals.
Yeah, thanks for having me.
So you're kind of the inverse of what I'm familiar with. You're focused on sourcing single family homes for people and then helping them with the management side of things. Can you talk a little bit of how you found your way into this niche?
Yeah, so single family for one reason, and in terms of the manager, I'll go into that one after. But single family because we feel like it's the sort of lowest entry point and a very safe one. Long term single family in a right A, B class, from a price point perspective, is attainable to many without having to sort of raise capital or do anything in terms of finding partners. So we do tailor to a certain type of investor who wants direct ownership and just has the capital, but does not want to be involved with any of the operational requirements. So what we do is we speak with each client, understand their sort of risk and price profile, put their financing strategy in place, and then help them find that home, secure it, renovate it, lease it out, and then take a long-term management approach. In terms of management, we consider ourselves as asset managers. So we handle everything from soup to nuts, entity, bookkeeping, and outsource all the services, but have pre-negotiated rates for everything. Our goal is to help you grow your portfolio, whereas, working with a property management partner may not do that. Constantly growing the portfolio while you get to focus on your personal and professional career.
So, can you talk a little bit about where is your primary focus then? Where are you sourcing these properties?
We mainly source from large off-market wholesalers and institutions that are doing dispositions, and again, large wholesalers that typically service institutions. That's like 99% of our deals typically. Sunbelt and Midwest.
What is your buy box on these? Is that particular depending on the investor you're working with, or do you kind of provide any consultation for those people that are new to the world?
Yeah, I'd say we provide more consultation to those who are new to the world. We put things into sort of an A, B, and C bucket. I think a lot of new people go gravitate towards the C because of the cash flow. And we're like, look, there takes a certain thick skin to go into certain C classes, but here's what to think about. And if they're adamant, we will go forward with their plan and intentions. But for the most part, a lot of our investors already have a prefixed a preference, and then we will search accordingly to them and even go after certain renovation levels based on their demands.
It seems like multifamily is an aspirational thing in our world. A lot of people start with the single family and then kind of work towards that, but you have kind of a different viewpoint on that. Why do you think that single family homes is kind of the bread and butter and where people should maybe consider staying?
Well, I think maybe not consider staying, but if they're, prefer, like, we think that it's a pretty low risk. We also think multifamily is low risk, but we do think that there's a progression in terms of maybe a cost per unit on a multifamily. If it's too low, then maybe you're better off on a higher class single family just because of the tenant profile and whatnot. And because, we're leveraging technology, we can diversify across multiple metros. And the way the investor looks or a client looks at it, they log into our site and they only see all their portfolio consolidated. So whether it's multi or single and multi geographies, it all kind of looks the same and same effort for the clients. But we do think there is progression to getting into a higher end, larger multifamily.
Can you talk a little bit about the benefits of investing in your backyard, like in an area that you know, versus leveraging a service like yours where you might be investing out of state?
Yeah. So, the clients we service are typically coming from the major metros where they're in the cities and states where real estate is excruciatingly high. They don't have the best landlord rules, and they're looking for the states where it is more affordable and better landlord rules. So that's kind of how we say, like, you probably don't want to invest in your backyard if you're like like of these certain cities and states. So giving them access to, let's call it, where all the other smart money is going.
Right. So let's talk a little bit about, or give us an example. Somebody's coming into your program for the very first time. Can you walk us through that process and maybe even include what they probably need to have in money reserves in order to get into that first property?
Yeah. So they would come to our site, they would create a free account, they could book a call. There's some property samples with pro formas and dynamic calculators you can play with to get a sense of what we can source. But ultimately, we want them to set up a call. We understand the buy box. So we'll go through pro formas and numbers, understand what kind of capital you have access to. If they don't have access to capital, we'll give them some guidance, go seek out an FHA or whatever it might be, or we can go out and find some DSCR loans and give you an understanding. So there's quite a bit of education and handholding up front. Ultimately, after that part, then comes a tax and entity conversation of what's the right entity structure, is it an LLC, whatever it might be. And then once they feel comfortable with all the numbers and the tax and everything, they say, we're ready to go. We'll help you set up your LLC, your bank account, and then we start searching. We find homes when they match. We'll do all the diligence, reports, renovation quotes, and even give you a 10-year forecast with some sort of refinancing strategy baked in there. And if the client likes it, we'll bring a third party title and escrow, help them close it out. Once you take ownership, our renovation team gets to work and then leasing it out. And then once it's leased, everything is in our dashboard. They log into our account, they get the monthly financials, operational updates on an annual basis. We'll do the tax prep as well as a forward looking strategy for the next 12 months.
So backtrack there a minute. You said you have your renovation team that goes in and takes care of a few things. Can you talk a little bit about what you do and to make it rent ready?
Yeah. So we leverage our large sort of institutional property management companies that typically don't work with mom and pop or individual investors. They quite large in nature. So their teams will go out, they'll kind of come up with a big renovation quote. We will then take that feedback and based on our assessment, say, look, you only really need to do like 20% of these renovations to achieve X rent rates. And then this is sort of what will kick down the road. We won't do any value add or infrastructure changes. So we won't turn a 2 bed to 3 bed, won't add washrooms, we won't do ADUs. Strictly, we'll go down to the studs, but nothing structural or value add.
Okay. So what would the typical situation be? You mentioned like first time home buyer buying programs and the like, but before somebody should even consider reaching out and contacting you, what is the I hate to put you on the spot like this, but the starting price, like what should somebody have ready
Yeah.
to jump in?
So the price points we typically source are 150,000 to 400,000, 400 being the A's, C's being the mid 100. So we would say having 25 to 30% down payments ready to go is probably adequate.
Okay. And when you're buying a property at 150 to 400,000, are you trying to hit the 1% rule? Like that's a kind of a common thing, or are you trying to exceed that?
Say it would slide from A, B, and C. I mean, C's are easier to get the 1% rule, where A's might be like the point 0.8 rule.
Sure. Okay. So, previously you were talking about what you do and how you work with an investor, and you mentioned getting the tax preparations and you're managing the rehabilitation of the property and everything else. It sounds quite a bit more than a standard property manager. That probably comes with a fee. Like, how does your group get paid?
Yeah, so we only get paid on two parts. So we do outsource the property management again with a large outfit. They have a lot of these operations in house. They will have their sort of fees baked into the costs. But our model, we only take off of two areas. One on the purchase, we take 3% upon closing. And then on the ongoing management, we have an asset management fee, which is typically on average about a 0.25% to about 0.5% of the purchase value annually.
Okay. So talk a little bit. I think a lot of people are going to be new to that concept, an asset management fee. Can you talk a little bit about that and what it would include?
Yeah. So asset management, like the hard things that we will bring to the table is essentially we are provisioning every single service provider that you possibly need to get a deal done from end to end. And every service provider we bring to the table, we can facilitate that conversation and do all of the work in between. Not only that, we typically have discounted rates on all of these service providers because we've got the buying power and the volume. So we think about everything from bottom line and top line. But ultimately, if you want to make the simple comparison, is we are acting as if you were, making sure that your property management is doing their job, that, following what the interest rates are and figuring out, hey, is now a good time to renovate and refi or sell or raise rents another 5%? Who knows? But we are the ones constantly thinking about your portfolio and urging the growth of it. Typically, that is the owner, and the owner will never get that information from their property manager.
So, going back to the 1% rule, and you said in some cases it can be like a 0.8% rule. And I know this is on a sliding scale as well, because if you're in a C or D class property, the maintenance is going to be quite a bit higher. But we definitely found that 1% rule. It actually makes it hard on a single family home to do the necessary cash flow. Can you talk a little bit about that? What are you doing to ensure that that property stays and makes the necessary cash flow just to sustain itself?
Yeah, so like, we use cap rates as well in single family. So you'll notice that on C and D class homes, the the total rental yield is quite high, but then the cap rate gap between the total yield and cap rate is much bigger versus an A product, right? An A product will have like
Mhm.
a point 0.8, but then the cap rate might just shrink just slightly bit below that because we know that the repair maintenance, the vacancy loss allowance allocations need to be slightly higher. So that's how we take into account. We do everything by zip code. We do all these calculations. We spend a copious amount of money on very zip code level data. So we do underwrite those and with higher risk, obviously.
So, can you talk a little bit? You mentioned you're kind of in the Sunbelt and Midwest areas. Like, what are some of the hot markets that you're working in right now?
Yeah, we like DFW, Dallas Fort Worth, Atlanta, the Carolinas. Those are like our great AB markets. And then we'll look in the Midwest for the C's. We like Pocket Ohio, the Memphis MSA, and those types of areas.
Can you share a story of somebody who came in and went through the process and where they are today?
Yeah, I mean, we're still relatively young. We've been in the market for about 3 years now. Our average clients are now creeping into across the board past their second units. We've done more units with them in their life in the past 3 years than they've done in the past 12 when they started 12 years ago. It's just because we're constantly being the ones that, hey, look, we should rethink about this. We have zero client churn, meaning like now none of our clients have left. Now we are starting to get clients who want to bring their portfolio to us to take over the management piece because we do have a lot of discounted rates.
Just to remind everybody, head over to sharesfr.com. That's sharesfr.com to learn more about what Andrew's team is up to there, and maybe they can help you get into a property. So it's sharesfr.com. And if you found some value in what we're talking about so far, do us a quick favor, share this with one of your investor friends. And if you're watching us on YouTube, give us a quick like and subscribe. So, a lot of people that are looking at properties, would you say it's fair to say that most of the people that come to you are trying to get into that very first property?
Yes, I'd say a strong minority of them. I think majority in the profile of our clients are those who've done backyard investing, either self-managed or with a property manager, and they just haven't had the best experience. Again, they're typically coming from tenant-friendly states, and they're kind of fed up. They see the value of owning directly as opposed to like a REIT or a fund, want more, but just are so time pressed and scared of these issues. So they come to us and like, okay, look, let's go to better places, find better rates, better returns.
Sure. So, with that being said, I tried like with some of my first rental properties were out of state and I got burned pretty badly by it. How do you make sure that you are selecting the right provider? What questions should we be asking to make sure that doesn't happen to somebody else?
Yeah. So we like, I think what we've to our own fault, provide a lot more information than normal. Like, here's your household income in that zip code, crime score, walk score, everything. And then the inspection and then the underwriting report is another 200 pages. So we really inundate our clients. And 100% of our clients are like, can I go see the home? And we say yes. And 100% of them never go see the home. So we give them every opportunity to do independent research because we never force them to a decision. They always have a window of time. We give them everything we have and say, look, go do your independent research. You can take us at face value, but always do your independent research. You will get visibility into all of our service providers. So you can do your independent vetting, but by no means do we ever put a blanket over your eyes in terms of what the information you need to make the right
Mhm.
decision. We give you everything.
Well, let's give some people a little guidance there. If they are going to do some of that vetting, let's say the property management, for example, you farm that piece of it out. What questions should we be asking to make sure that they are a decent property manager?
Yeah, I think the question to us is like, what if we don't like the property management company? And then our response there is like, well, you should never really be speaking to them. They'll only be speaking to us. So we funnel all of that through to the client. And the truth is, if you're not happy with them, that probably means you're not happy with us. And then what's your termination policy for us or the property management company? So we have 2 to 3 property management partnerships across the country that all have overlap. Our contracts with the property management company are non-sticky, meaning we can give them 60-day termination notice and then bring our portfolio to another partner if that becomes the case. And then clients with us, you can fire us at any time. You have the ownership, the title is yours. We just want to be made sure that we get made whole of 2 years worth of our management fees. So if you're halfway, like if you're 12 months in, we'll just prorate the other 12. There is an offboarding fee of 750, and then you can fire us and self-manage.
Okay. So, talk a little bit about right now, it sounds like you're acting as that middleman, as you would call it, an asset manager. It sounds like you have an online portal where all of these communications are going to be going through. How do you make sure that doesn't happen and that everybody is in lockstep?
Yeah, so we have because the property management companies are quite large and they're typically used to working with large institutions, we kind of fit into their process. So we have like a weekly update meeting. So I guess to your point, it may be 1 to 4 days stale, but we do have different contacts in different departments, the renovations, the leasing team, where we can go ad hoc and then go to them and ask for some information. We try to keep everything sort of truncated to weekly updates on homes that are in different stages and then passing through like we have plug into their system. So usually if there's anything that pops up, we get notified in real time and we can pass that through to the client.
Okay. So this online portal, is that something that you created yourself or is that a tool that you've learned?
No, we created everything. Almost everything is from scratch. We pride ourselves as being a real estate technology company. And yeah, so that's what we build. We build robust accounting systems and communication systems for working with our property management partners and then bringing it all the way down to a per client basis.
Just kind of wrapping back up to what you initially had said, you mentioned that single family homes as rentals is one of the safer investments. Can you talk to a little bit about why you believe that is the case?
Yeah, so I think we saw that also during the pandemic in terms of hierarchy of needs and space and the demand for that space of a family. I'm not saying all single families are, but I would say the A and Bs are highly safe just because you got long-term tenants. They're typically higher profile, ones that are just getting priced out of the home ownership market. So they're typically longer tenures. The tenant bleed over of any sort of one multifamily tenant tainting it for others. This is their own space, dogs, family, kids. So you get long-term longevity. But do the returns compare to multifamily? Maybe not, right? But in terms of stability on that one unit, we believe that is rather resilient. And we do see that during the recession, the pandemic, people were vacating their condos and moving into suburbs, wanting to get more space, signing long-term leases. And that's where we feel like there's a lot of, it's sort of your plain vanilla dip your toe in and then, yes, progress into the higher ticket multi.
Sure. You mentioned the economy. What is your outlook? What do you expect? How are things going to change over the next few years?
Yeah, that's interesting. We're seeing now that the rental demand is definitely still there amongst all the classes. The rejection rate of a lot of the tenants in like the C class is going up. I would say applications are going up and then rejections are also going up disproportionately with all of the interest rate hikes and where inflation was. A lot of the C class tenants are really feeling that burden now and it's starting to ripple. downstream compared to 12 months ago where we would see a higher, more qualified percentage. Now you're seeing more of it. So it'll be interesting. I think Section 8 is going to be blowing up and, you're going to see a lot more of those. And we do think coming and getting a house that potentially is already leased is a good hedge, and kicking down your sort of renovation and capex down the road is a good strategy. But yeah, we do see the tenants feeling it. So it might not be the best time to try to raise rents.
So with those changes, I would imagine that your company is used to it by now, where you've learned to adapt to any of those market trends and changes. What mechanisms do you have in place to try to help identify these things before they happen so that your investors are kind of in front of it?
Yeah, so we kind of well, our underwriting changes. Obviously, we put more risk baked into sort of the reserves and repair maintenance and vacancy loss allowance, but moreover, shifting them into again some of these lease back opportunities, which we get a lot of, where sellers in a bit of a bind. They want to stay on as a tenant, but they want to sell the house. So for that, as an investor, like, okay, well, I could just pay the purchase price. You can still give me my estimated renovation budget, but I get to kick that down the road a bit. And now I have zero carrying costs because it comes. So day one, it's cash flowing. I can buy it for purchase price, and the tenant typically has a bit of emotional attachment to the home. And even if they're in a bit of a financial credit bind, we know they're coming into some cash. So what we can say is, hey, look, give us 3 or 6 months upfront as a security deposit. And then, yeah, we'll give you a pretty decent rental rate. So now we've really hedged that. And then as interest rates kind of subside, the market gets better. We'll be like, okay, well, if this tenant turns in a year or two, let's do the renovation then and then go out and refi, pull the capital out, and here's what we think we'll get. So we give them a very forward-looking strategy.
So you're helping them with the whole BRRRR process, really.
Yeah, without aiming and targeting an ARV per se.
Right. Okay. Well, this has been a really interesting conversation, Andrew. Before we jump into the rapid fire questions, is there anything that you wished we would have covered to this point?
No, I think we covered all the basic principles.
Well, if you're ready, we'll jump in and we'll close out this episode.
Sure.
So, first off, what lie do real estate investors sometimes tell themselves?
There- it's a cash flow haven.
Yeah,
Paper rich, cash poor.
paper. Yeah. If you could go back in time and give your younger self one piece of advice, what would that be?
Oh, go faster.
What are you reading right now?
The one book I always recommend is The Hard Thing About Hard Things. It's more of a technology CEO thing, but it's like you need to look at the horror stories before you enter anything entrepreneurial. So you're ready to embrace chaos. And that's what that book is. It's chaos.
What single strategy, process, or tool have you implemented that has had the biggest time saving impact to you or your business?
For my business and for me, it would be Loom, which is like a screen recording and conversation, like short form video where I can record and respond to people and then just send them the link to that video and repurpose that video for many other things.
Sure. No, I appreciate that tip. Again, head over to sharesfr.com. That's sharesfr.com. That's going to be a clickable link in the show notes. But this was a great conversation, Andrew. I really appreciate
Yeah.
your time here today.
Yeah. Thanks for having me.